Now, with respect then to our current situation, actually, I mentioned yesterday I was giving a lecture at the OECD here in Paris, and this is what I was lecturing on. In the book I wrote with Steve last year, what I really hypothesized is this idea that for the last generation, for the last 40 years or so, what we've seen is central banks creating larger and larger debt bubbles by setting lower and lower interest rates. So from the 1980s onwards, every recession has been responded to by central banks setting lower and lower interest rates. So when the bubbles of the late 1980s burst, if you think about America, for example, Alan Greenspan set interest rates at 3% in the early 90s, the lowest for generations. And that, combined with the Greenspan put, served to create an even larger bubble, the dot-com bubble. Then when that burst in 2000, the response was even lower interest rates of 1%, which then created an even larger bubble, the housing bubble. And then when the housing bubble burst in 2008, the response was the lowest interest rates in history, years and years of 0% interest rates, and that has created an even larger bubble than 2008. And we're now just in the early stages of that bubble bursting, with these banks going under in America and some of the other things we've seen over the last year or so. In fact, in 2008, global aggregate debt, so that is consumer debt plus corporate debt plus government debt, was around $150 trillion. So that was already by some margin the largest debt bubble in history, both in absolute terms and relative to the size of the economy. But after years of 0% interest rates, that reached around $300 trillion. So since 2008, far from bringing about a return to prosperity, what 0% interest rates and other central bank policies have done is essentially double the size of the global debt bubble. So we're going to look at some data illustrating this now, and this is where it's worth just thinking about this IMF position that central banks need to be able to set low interest rates to stimulate the economy, again, versus this Friedrich von Hayek position that no, setting low interest rates distorts the economy, it causes debt bubbles, and it causes all of these other problems. But it is not just the Federal Reserve that's been doing this. Here is the European Central Bank from its inception in the year 2000, and the Bank of England and the vast majority of other central banks in the developed world, at least, have followed this same pattern over the last generation of responding to each recession by setting lower and lower interest rates. So that then, the initial thing we'd look for is the growth in debt over this period. And what we're going to look for is this going to grow in a line with these four phases of lower and lower interest rates, pushing up the size of the debt bubble with each phase. So the initial thing that we look for is the growth in debt, and that's what we see here from the growth of this bubble in the 1980s onwards. But also, as I said, when interest rates are set artificially low, it disincentivizes saving. So what we'd also expect is with each phase of lower interest rates, we have both a growth in debt and a fall in saving. And interest rates are here in yellow, and that's clearly what we can see is with each phase over the last 40 years of the growth of this bubble, we see a larger divergence between savings rates and debt. Onto asset bubbles then. This is very simple, but actually one of my favorite metrics for asset bubbles. That is net worth relative to GDP. If you think for a moment about if you were looking at housing bubbles, what you would look at is the price of the average house relative to average income. And that's often a good metric as to whether you're in a housing bubble. What this does is it looks at all assets in that same way, stocks and everything. And clearly you see here, again, with each phase, you see it growing. So you can actually see in 2000, for instance, the bubble started to burst after the end of the dot-com bubble. And then that's where Greenspan set in and set interest rates at 1%, and you see it take off again. Now, where you see this asset bubble falling, that is not a bad thing. That's the market trying to deflate the asset bubble. This asset bubble needs to deflate. But every time the asset bubble wants to deflate over the last generation, central banks step in and set interest rates even lower. So again, you can see from around 2008 onwards, you can see it gets completely out of control with 0% interest rates. And this graph goes back to 1950, from when they started gathering these data. So you can see it's completely out of control compared to previous generations. And that then is the same metric, so net worth relative to GDP, and looking at that relative to interest rates. So again, we can see with each dose from central banks of stronger and stronger monetary policy, we see these asset bubbles getting more and more out of control. We'll look a little bit at stock markets then. And if we think about, this is the Shiller PE, so the cyclically adjusted price earnings ratio. And you can see the peaks are larger during the last generation than even 1929. But what's perhaps more interesting actually is the decadal averages, which are shown in red. And so every decade during the growth of this asset bubble has had a greater average PE ratio than any decade in recorded history going back to the mid-19th century. And again, this is a consequence of central banks creating larger and larger debt bubbles and sustaining these asset bubbles more and more with lower interest rates. But here we also have the buffer indicator. So that's the size of the stock market relative to GDP. So Warren Buffett said that this is probably the best indicator there is of a stock market bubble. You'll see there actually the second peak is not quite as high as the dot-com bubble, whereas the other ones that we've looked at, it goes completely off into the distance. The reason for that is that although that's the 1% interest rates credit expansion, so although that was a larger credit expansion during the early 2000s, a lot of that, of course, flowed into the housing bubble rather than stocks. But then as soon as you go to 0% interest rates, you see it completely take off again, of course. And that's Tobin's Q. Again, I don't like that as much as the previous two metrics, but it's worth just noting the decade averages, that it's higher than since records began during the growth of this bubble. The question then, if we're looking at stock markets, is, well, perhaps these stock market valuations are being driven by genuine belief in future investments, future technological breakthroughs, let's say. So then, from a Hayekian Austrian school point of view, we ask, well, is it in fact just being driven by artificially cheap credit? And so here we have margin debt. Again, you can see with each phase of the inflation of this bubble, margin debt grows more and more. Now that's in absolute terms, in billions of dollars, but also if we look at it in relative terms, so relative to market cap, we also see it growing. But you may look at that and say, well, these other metrics that we've looked at go completely off into the distance, but that's not, the magnitude there isn't completely crazy, but that's relative to market cap, remember. So we looked at the size of market cap relative to the economy and how much that's been inflated by artificially cheap credit. And so we have, this is relative to that. So that's actually a huge increase in credit-fueled stock market bubbles. And for the book that we wrote last year, we wanted to create some metrics for this. So we created a metric for stock market bubbles, which is a composite index of the buffer indicator and margin debt to market cap. So in essence, what this metric does, we weighted them both equally. So this looks at the size of the stock market relative to the economy, and also the extent to which the stock market is being fueled by artificially cheap credit. So this is, if you like, a Hayekian indicator of stock market bubbles. And again, we see with each stage of lower interest rates how much is being inflated. And Bill White was chief economist at the BIS, and we did a few interviews with him. He's one of the top economists, and he actually talked about the IMF's failure to predict the Asian crisis because they weren't looking at these things that we're looking at today. Again, the IMF takes that position from the slide that we saw earlier, where they are definitely true believers that low interest rates will solve these problems. And here we have house prices then. So as I go through this, again, it's worth just remembering this battle in terms of ideas about business cycles and how it relates to private forms of money is whether central banks really do save the economy when they set low interest rates, as is taught in macroeconomics courses, as is taught in IMF papers, versus the Hayek idea that all they're doing is distorting the economy, causing asset bubbles, and all of these other things that we're looking at, because that is really the crux of the matter here. And it's going to be a central point of discussion in future years as more and more people use more private forms of money. So again, here we have housing in the UK, and you can see with each phase of the growth of the bubble, you see house prices getting out of control. This has a lot of social implications, because if young people can't buy houses, they often tend to not have families, and there are a lot of other implications as well. This is average house prices relative to average earnings. So this is probably more of a social impact than stock market bubbles, the stock market bubble data that we've looked at. And this is real estate loans against commercial and industrial loans. And you'll see before the growth of this bubble, productive lending was actually greater than real estate loans. But from the growth of this bubble onwards, you see them diverge, and essentially speculative real estate loans get completely out of control. And right, so here is another critical issue when we look at business cycles, is the quality of bonds. So with each phase of lower interest rates, what we've also seen is a degradation in the quality of bonds. And this may seem like a fairly abstract issue, but this is what's in people's pension funds. Okay, so with artificially low interest rates, people's pension funds are being chock full of very high risk, very low quality debt, because they need to get some type of interest for the pensioners. So this is yet another distortion caused by low interest rates. Again, so that point brought up by the IMF earlier about how if people are using private forms of money, central banks won't be able to stimulate the economy. This is what we're talking about. This is the type of distortions that are caused by central banks with these policies. And this is investment grade portfolios. And you see also the lowest grade debt in investment grade portfolios. Eventually, with each phase of the lower interest rates, eventually the lowest grade debt makes up more than every other strata put together in investment grade portfolios. Again, so this is people's pension funds being stuffed full of very bad quality debt with each stage of lower interest rates. Now, we wanted to come up with a few metrics to look at the size of the bond bubble. And one that we quite liked was from two professors at Harvard, Greenwood and Hanson. And they looked at the percentage of bonds issued, which are speculative grade versus investment grade. And you can see here it has great predictive capacity. You see here the growth in speculative grade bonds is a good predictor of default rates in the next time period. So what we did is something slightly different. We essentially took speculative grade debt and divided it by investment grade debt. But we also took BBBs, the lowest, most speculative form of investment grade debt, and put it in the numerator. And so we turned this to bond risk ratio. So this is a metric for the buildup of risk in bond markets. And you can see this during this period and what it actually entails, these artificially low interest rates, in terms of the buildup of risk in bond markets. And another quote then from Bill White, where he's talking about when he was at the Bank for International Settlements. So that's the central bank of central banks. I interviewed him in 2015, just as the ECB was really getting going with QE. And he was very skeptical about whether QE was going to fix anything in the economy. And he notes here that even from around 2002, 2003, Ben Bernanke was there, who was not yet governor of the Federal Reserve, and also Masaki Shirakawa before he became governor. And he was warning about this trend of lower and lower interest rates, what it would lead to. But Ben Bernanke was saying, no, it will be okay, there's other things that we can do. But in Japan, where they did all this stuff before us, they were already warning, no, this is, it becomes ineffective. Of course, as we're seeing, it's worse than ineffective. 0% interest rates is not just ineffective, it hasn't just led to stagnation, it's caused terrible distortions to the entire economy, everything from asset bubbles to bond markets, and as we'll see also malinvestment and zombie companies. So the last few slides then on this, before we get back to looking at how this relates to the future money. But this is all crucial in terms of how this ties into the business cycle. So this is delinquency rates in the US. And you'll know that with each phase of lower interest rates, that's fewer and fewer companies getting into financial difficulties. So a central banker might look at that and say, wow, that's a great success. Over the last generation, we've set lower and lower interest rates, and we've been preserving all of these businesses. We then have to ask what types of businesses are being preserved with these policies. And so we have here, from the Bank for International Settlements, 14 developed economies, and we have the growth in zombie companies. And in the 1980s, it was around 5% of businesses were zombie companies. That's now up to nearly 20%. Nearly a fifth of companies are zombie companies. And again, you can clearly see the same pattern that we've been looking at with all of these things today, as central banks set lower and lower interest rates. So this is the consequence. It's not even just the asset bubbles, it's not just the bond markets, it's bringing about chronic stagnation and chronic lack of productivity in the economy. And in the book, we wanted to look at some different metrics for malinvestment, so the low productivity caused by central bank policies. So what we did was we took asset turnover ratio, return on assets, and return on equity, and we put it together into one composite index as a useful metric for this. What we wanted to do was look at the marginal productivity of debt. So with this huge explosion in debt that we've been looking at, is it actually being used productively? Are these businesses actually inventing new things and so on? One of the ways that the people have looked at this is to look at the marginal productivity of debt in terms of GDP. So with each additional unit of debt, how much does that increase GDP? Now that has been useful, but the problem with that is if a business borrows hundreds of millions of euros, issues bonds at 0% interest rates, if they just buy Ferraris for all of their directors and buy Samsung TVs for everybody, nice art on the walls and so on, that likely will not increase productivity, but it will increase the GDP of the economy. So that's why we created this specific metric, the Economic Performance Index, which, as I mentioned, that takes asset turnover ratio, return on assets, and return on equity into one composite index. And here we see that relative to the growth of debt over the last few years. So that's our initial clear indicator that this huge growth in debt that we've been looking at, far from stimulating productive investment, is actually bringing about more and more malinvestment. It's making things worse within each incremental unit of debt. And that then looks at that last slide as a ratio. So the Economic Performance Index divided by liabilities. So the marginal productivity of debt is essentially less than half of what it was around 2005 when the OECD started keeping these statistics. So that's, but you may say, well, is that really a consequence of monetary policy? And so on this next slide, the final slide actually on this, we're going to look at the European Central Bank and how it relates to this. The European Central Bank during this period was by far the largest buyer of corporate bonds. They bought trillions of euros of corporate bonds. Now their argument is, we're putting all of these trillions of euros onto the balance sheets of businesses so that they can invest, they can employ people, we're going to stimulate the economy, it's all going to be wonderful. If you've ever seen an ECB conference or read any of their papers, that in essence is how it's described. But if we actually look at it, in the red line we have the ECB balance sheet, and we see actually, in essence, the more the ECB was buying bonds, the more the Economic Performance Index went down, the more the marginal productivity of debt went down. So again, why is that happening? Well, if you think about a business, if a business can issue hundreds of millions of euros of 0% bonds or even negative interest rate bonds and just sell them to the ECB, it's essentially just free money. So do you think those companies are going to be innovating, or are they just going to essentially become a zombie company and just take the free money and again just buy Ferraris for the directors? So this is a clear indicator of what has been happening with this huge increase in debt, a lot of it being bought up by the ECB.